Hey, how's business going? I know this must be a slow time of year for you. Yeah, winter is a slow time. It makes it hard to pay the bills when it's too cold for customers to want to come out and spend money. Cash is so tight. How tight is it? Cash is so tight, I had to put some of my own money in this winter just to keep things afloat. Bummer. Does this happen often? It seems like it happens about every winter. But when the spring comes, business kicks in, I get my money back. So it ain't too bad. But it does make it hard to budget your cash in the fall in order to make it last until spring. It sounds like you can benefit from getting a loan with the bank. I thought of that, but I don't want to pay interest all year long when I only need the loan for a season. If you get a line of credit, you won't have to. You only pay interest when you carry a balance, and when the spring comes, you pay off the loan and you don't pay any more interest, at least until you need to. That sounds great. Tell me more. If you have been in business for a few years and have built up a positive track record, you might be able to get a loan from your bank. Today we're going to talk about the two main types of loans businesses get: the line of credit and a term note. We'll talk about what they are, what they typically are used for, and some general characteristics. First, the line of credit. What is it? So when the bank allows you to borrow up to a preset limit. You don't have to borrow the whole amount, but that much is available to you in case you need it. The interest is only calculated on the amount that you have outstanding at any given time. The normal use is for things such as business seasonality. If you have slow periods of the year, say if you were a restaurant or a bar and you're slow in the winter, that would be ideal for a line of credit. When you have some timing issues, as for instance, on construction jobs, during the first part of the jobs, the contractor is often out of pocket until about halfway through the job. That would be a good use of line of credit to fill in the gap. If there is a balance all of the time, like all year long, it may indicate that the company maybe is not cash flowing that well. It might be time to reevaluate the business and make some changes. Perhaps you need to put some private money into the company. God forbid. Let that be a last resort. Maybe you need to trim expenses and improve the performance. Improve the cash flow at least. Look at your receivables, look at your payables. Also, you should look to see if a term loan makes sense for you. Normally, line of credits will often be tied to your business checking account. Funds can be swept to and from your account as needed, and this makes it very convenient. Interest amounts sweep out monthly. The interest rate tends to float. It often resets about once a month. Maybe only once a quarter, but usually about once a month. In the past few years, interest rates have not fluctuated a lot, so this aspect is not usually a problem. When rates do jump a lot, that is when this could be more of an issue. And there is no prepayment penalty, not usually. So now term notes. What is it? Well, the bank provides loans to you up front. It's not like you can take some now and maybe take some later. No, you take it all up front. Interest starts accruing right away from day one, even if the funds are just sitting in your checking account not doing anything. The normal purpose for a term note would be for things such as funding capital projects, buildings, land, large equipment, vehicles maybe. For term notes, the monthly payments is often a fixed monthly payment amount that represents both an interest component and some of the principal balance. And it's usually fixed in terms of a length of time, often in years, whether it's 3 years or 5 years, 7 years. Usually you're not going to get a longer term unless you have real estate involved. Most loans are set up so that when you get to the end of the loan is paid off just with the normal monthly payment. Some, however, are not like this. There could be a balloon payment due at the end of the term. When the loan is like this, the idea is that you will negotiate a new loan just prior to when the balloon payment comes due. This allows banks an opportunity to change the interest rates if necessary. This can be pretty inconvenient, so be aware of this. The interest rates can be floating or it can be fixed. Just need to read the details. Now, there may or may not include a prepayment penalty, so watch out for this. If your business is cash flowing very well, you may want to pay off that debt sooner than the schedule. If your loan agreement has a prepayment penalty, you'll be punished for paying the loan off early. That effectively traps you into the loan until the scheduled maturity date. Again, watch out for this. Can you have both? Well, yes, many companies do. Some start with adding smaller assets throughout the year using their line of credit, then lump these amounts together to support or justify a term loan. For example, let's say in May you bought new computers for $10,000 using your line of credit. In July, you buy a new point of sale system for $25,000, again using your line of credit. In September, you have some remodeling done and it runs you $25,000. If your bank is cooperative with you, you could take the $60,000 and convert it over to a term loan. When this happens, your line of credit balance will decrease by the $60,000 on the same day that you incur a $60,000 term debt. Some companies will just plan on using term debt to fund large expenses and then use a line of credit for normal operating timing differences. The interest is usually tax deductible as a normal business expense. This could be a way for smaller business owners to delay having to put in more of their own money to fund the company. It's not free, but it does add flexibility. Now, normal bank loans, whether they are term notes or a line of credit, they do not take an ownership interest in the company. This means that they do not share in the profits. If your business does very well, that does not go to them. The bank only gets the money based on the loan agreement. But on the other side, if the company does not do well, the bank still demands their payment. Is there another option? Well, some banks will allow you to use your larger purchases to create a lease. On paper, it looks like you are selling your equipment to them and then leasing it back from them. It functions a lot like a term note. You should talk to your bankers to see what options are available for your business. This has been Managing Your Business by the Numbers. My name is Randy Helm. Thank you for watching this video. If you liked what you saw, be sure to subscribe to this channel and hit the notification bell so that you do not miss out on any new material. Also, please leave a comment down below if there is a topic you would like me to cover. Until next time, have a good day.